We have started with the Sachin Tendulkar of the taxation, that is tax guru Girish Ahuja sir. Now with them there is a requirement of a सेवाग. अगर हम 2000 की बात करें तो प्रदीप कपासी सर जो सेवाग है ऑलरेडी डायरेक्ट टैक्स के, he is going to discuss about real estate. Discussing about this sir. Pradeep and Kapasi sir is a chartered accountant and law graduate. He is a partner in Pradeep Kapasi and Company, Mumbai. He is past president of Bombay Chartered Accountant Society and the Chamber of Tax Consultant. He has co-authored many books and contributed articles in many professional forums. He was a lecturer and visiting faculty at Jamal Bajaj Institute of Management Studies and IIM. And we are waiting for sir for more 2 minutes and we'll start that. Till then I request Bisan sir to please join here. Sir, as informed by me that after Sachin there is a requirement of a Sevag and Pradeep sir is already a Sevag for direct tax, and without wasting any more time, I request Bisan sir and me to facilitate sir.
Good afternoon to all of you. I thought that I would wish you an early good morning, but as the design is that, so that, and my sincere wish is that I don't wish to encroach on your lunch time. So I'll try to see that, I was initially scheduled to start at 11:45 and shut down at 1:15. Now it's for the organizers to permit me to start at 12:45, but if you permit, I'll shut down still at 1:15. No, fair. There is, no, we would try to do best. I was just looking into my, see the back records. So somewhere in 2021, I was invited to this place by ICAI Ahmedabad branch to talk on a subject which was somewhat similar to this, Then in 2022, you all had come to Bombay for a residential refresher course, and once again the subject was similar. And in 2023, I am before you to once again talk on a subject which is again real estate. This time it is little different. But it's real estate. So I was just wondering, that is it that my case is similar to that of a famous singer? He was once invited to sing. And after his song was over, there was once more. So he was happy. Obviously, any singer, any speaker is happy if his performance is well received. So he was happy and he did it again. Once again, there were a lot of claps and saying once more. This went on for 6 times. Now he was, because he was otherwise a sensible person. He said, am I doing something wrong? The participants said, yes, sir, you are doing something wrong. Till the time you sing it appropriately and well, we'll keep on asking you to sing it again. Is it my case that I didn't do it earlier? Well, so I will today try to see that, okay, we make up for the things. We have got together to talk about real estate, and no understanding of real estate is complete without understanding the law behind the real estate, which by itself is complex, without understanding the accounting concepts behind the real estate, which are way different than the normal accounting concepts. Part of it, whether it's direct tax or indirect tax, and those of you who have been in practice are surely aware that that these things are no ordinary, they do not have ordinary answers. So our normal understanding of the Income Tax Act, of the accounting standards, or even for that matter, the generally accepted accounting principles do not really help us here. So therefore, this is something more that we need to devote some more time. what we will try to do is that, yeah, we will try to skirt some of the issues, try to take up some of the issues. I request that if you have questions, say, right, we would try to keep it at the end. And if in any case, if there is no time, because the time between the time when I end and the lunch time for all of you, then in that case you do write to me and my office and me, we will surely respond to that. So don't worry about it. Normally what happens when there are complexities galore, they are all around. But in such cases, the wisdom which is supplied by the experts or by the courts, finally decide and conclude the issues. Unfortunately, in these cases, whether it's accounting pronouncements internationally or nationally, or whether they are tax decisions, or the circulars, including those issued in the arena of the GST, none of them really solve anything. They just complicate it further, leaving all of us to think more and more about what we are actually doing. So this is all the more reason that any advice on real estate taxation, real estate accounting, even application of the laws, general laws, legal laws, they would have more than one opinion and sometimes more than 2 or 3 opinions. So everything what we will discuss today, we will take it with a pinch of salt, with a clear understanding that yes, that whatever I am sharing you is something which I have understood, and not as a professional but as a student. And my endeavor would be that I would share with you whatever I have learnt over a period of years. And if you have a different view, maybe you are right. Maybe you are right. So do not believe that what I am saying is ultimate, but it would surely titillate your thinking in that direction that there is another view also. And therefore there is a need to apply your mind a little deeper into the subject. No, somebody has to help me. This is not moving. Yes, yeah. Okay. So what we are going to do today is we will discuss about joint development agreement, pure taxation and pure direct tax alone. There are general agreements of hundreds of types, and there are specified agreements which are prescribed by section 45(5)(a). This is, I believe, is the major topic for discussion today, and we will try to do justice to that. There's something, will we be able to tell Sunil Bhai to postpone the flight? Just, he was trying to do so. So please try to, sorry for this. Then we'll deal with method of accounting, which is very important for the purposes of understanding the taxation. So I've been told that, I should deal with the percentage of completion method and also the project completion method. I thought that, maybe now project completion method has become archaic and therefore is not of much relevance. But when I look into it, maybe, for those of us who are die-hard practitioners, maybe there is a scope, and then in that case, how to go about it, so that we will see. Valuation of inventories is something I am dealing with it after a long time. Not many issues are around that, but I'll present some views before you. And that, time permitting, I am told that, one needs to also take redevelopment issues. Now, with Sunil Bhai's consent, I have agreed that, we will narrow down the scope of redevelopment. Thank you so much. Yes. That will narrow down this to redevelopment of only society premises. There could be premises which are slum premises, there could be premises which are tenanted premises, chawls, and so many other redevelopments are taking place, at least in the city where I live. So I have sought his permission that time permitting that too, will concentrate on society premises, because he has been able to find out that maybe that in this city, the issues are more surrounding redevelopment of society, because not there are many tenancy premises. So this is what we are set about to do. So generally, if we look into this building and redevelopment industry, it's one of the key drivers of the economy. Infrastructure is topping it, but in major cities, even ordinary redevelopment, regular development, all of them is contributing in a fantastic manner, to the economy, and it's virtually driving the economy. There was a time wherein we were literally driven by the software information technology industry, but it is not so anymore. But what is once again peculiar to this is that there are very scarce resources. Traditionally, for some reasons and even financially, other than NBFCs, are not very keen to lend money to real estate persons. Maybe at times working capital funds are provided, but the main working capital, which is purchase of land, which is the most costliest factor, that even today it's very difficult to acquire loans or finance. So resources are very scarce. When I was traveling, from airport to here, I had a detour and we went to some other place. So, and thereafter I came here, so it permitted me to really have a good look at what's happening in Ahmedabad, and I was very impressed. Your roads are wide, you have very nice office buildings, something which is not possible. I've never seen it in the city of Mumbai. So therefore you are fortunate, but that also indicates that the industry is really kicking and live in this city. But what is happening here is that every separate project is a project by itself. It's in the sense that it is an entirely unorganized sector. If you look at in the developed countries, see that townships are being developed by one single developer, which is not so happening in our country. So this is a highly unorganized sector. Yesterday, somebody who was driving an auto rickshaw could be a very big builder. So we do not know that, that, and everybody is invited to join the bandwagon. So this is another thing. What sets apart this industry is that, the practices which at times can be considered as questionable. These practices by tradition are practices for which there are no accounting answers, there are no tax answers, and such practices at times create their own questions. So therefore it is all the more necessary to address these issues and understand it a little different. The joint development what we are talking about is a need of an hour, need of the day, need of the week, and need of the year, and perhaps the need of the days also. Because the traditional method of developing a project is no more possible because of the colossal investment which is required for any good project. And so therefore people have to come together, they have to pool their resources in order to bring the material on hand, in order to bring the skills, which again is rare, and in order to bring finance, which is very scarce. So all these things, including manpower, are the issues which this industry is facing, be that infrastructure development or be that the regular development. So one needs to think of it. So what is the present day happening is, what is happening today is that the model commercial arrangement is somewhat like this, that there is a landlord, he is sitting on a land bank which is substantially valued, for which there is no substitution. You cannot develop a project unless there is land. It's the beginning point. So for starting point, there is a man who has the land, but who has no skills to develop, who has no finance to develop also. As against that, there are people who have over a period gained experience in developing, in licensing, in getting the plans approved, in designing, and finally pulling the resources, manpower in order to construct it. So which again contributes a major part in this activity. So these two people, when they come together, what arises is a joint development, which is loosely called this. There is a gentleman who has land and there is a gentleman who has the resources, the capacity to develop. So that is what is all about joint development agreements. So when these two agencies come together, what happens? The firecracker happens. And therefore, see that how to handle those firecrackers, how to douse the fire. This is what is something which we will have to talk about. The cost is entirely that of the developer, and the land is entirely that of the landlord. The agencies, that is both these people, assume different functions. At time, the one says, besides bringing land, I'll do this and this. And the developer says, I will do this. At times this, they synchronize so well that it is difficult to identify that who is doing what and who is responsible for what. And at times several different functions are assumed, which again will have different tax implications. So structuring a JDA, is always a challenge. And it is here that you all as chartered accountants can contribute a lot. Traditionally, see what was important in law was that whenever a development agreement or anything relating to a property, immovable property, was being done, what was paramount, importance of paramount was that, okay, your title should be, your right should be proper. And that is where the lawyers used to rule the roost. In the sense, the solicitors or the lawyers would decide that how it should flow. But in today's time, what is happening is that the cost of any agreement is in the form of, first, the huge stamp duty you pay. There are registration charges. Then there is income tax, which might immediately, even the day you pen and ink the agreement, it might be payable. And there are serious GST issues also. So in such circumstances, as a chartered accountant, my personal view is that you play a major role. And when as a chartered accountant you acquire also the skills of lawyer, then in such case, see that your presence in the structuring of a JDA becomes very pricey and perhaps indispensable also. So it's for you that, whether you should look into these aspects or not, because personally I would believe that yes, there is a great opportunity and that opportunity would survive for another 1 or 2 decades. So kindly look into that. There are development agreements which are executed for a pure vanilla monetary consideration. This is one kind of a thing. But it is presently not something, which is a rarity. It's kind of something which is in the museum. For the reason that, nobody sits on such kind of a cash. And even if one has cash, he would rather utilize for construction and development and not for acquiring the land. So therefore, this first kind of a transaction is little less. But it's not that it doesn't happen. The smaller developments happen with cash. The second is that, okay, you and me come together, we share revenue. The revenue is not the profit, it's the top line which we share. Whatever percentage is the consideration is received, a part is retained by one person, the other part is retained by another person. These are the usual JDA which are presently in practice. But that is not the only JDA. There are also JDAs wherein the profits, that is the bottom lines, are shared. So which again has different tax challenges. The first two also have different tax challenges. And the first one itself, even when the cash is paid, it's not that the taxation is simple. So we'll try to understand that. And the last one is also widely practiced, it is area sharing. That instead of sharing the top line or the bottom line, I would say that I am the landlord, I will retain 35% or 45%, and the developer would retain 55%. In my city, the standard norm is somewhere around 55 and 45, which at times, is 65 and 35 also. So you will have to, but as I see, in other parts of the country, yes, that, that what is development and construction cost happens to be substantial as compared to the land cost, and the ratios will be accordingly tweaked. So one will have to think about it. Because of the challenges which is faced, which is thrown by the first four arrangements, there is a serious consideration that should we not invent something which is innovative, which is novel, and which does not hit me with all these issues relating to taxation and all. The present day innovation in the last couple of years which has happened is the development management or consultation agreements. So this is something we will talk about it, but this is something primarily is an arrangement where under there is a developer who has skills, who has funds, and the landlord does not part with the title in favor of the developer, but the developer agrees to rest his case by providing all facilities which otherwise are required for a good development. So in such circumstances, it is believed that there is presently lesser quantum of complications in the matters of tax and stamp duty. Let's see whether we will do. The next area, which is also a structuring area is that instead of doing any one of the five things, we get into a joint venture. We constitute a special purpose vehicle openly by naming the vehicle as an SPV, or otherwise get into a loose arrangement which could be classified as an association of persons or a body of individuals. Once again, this could be very dangerous, wherein without knowing that you are falling into some relationships, you might still get into such things. So this is something you will have to be more careful. Then there are cases wherein because of the huge tax instances, you are advised that if you want to be retaining 50% share in the developed area, then in that case, why don't you retain in the first place 50% of the land bank and transfer only 50% of land bank? Mind you, this is not so easy as I am making it out to be, because there are serious title issues, there are marketing and selling issues also, administration and management issues also there. But in some cases, yes, that this is something which has to perforce be agreed upon, because it saves on substantial quantum of taxes at that point. So there are partial transfer cases also, which is also part of structuring. When a corporation, a company is holding land bank, then in that case, at times, one has thought of demerger, one has thought of slum sale also. Now, these also at times could be very, very innovative and productive. So that is also is not something which is not practiced, widely practiced. Then innovative structures, every day you learn something new, whereby, with the, wisdom supplied by many people, you innovate a structure which is something which is not practiced in the past. So there is always a scope for an innovative structure. Somewhere in 2017, when the climate was very hot in the matters of direct tax and also post GST in the matters of GST also, the then finance minister Arun Jaitley seriously considered this aspect, that here is a case the landlord is transferring something for say 50 crores of rupees, and therefore upfront he is required to pay about 12 crores of rupees. There is no money for payment of this. He will get money after 5 years. Then in such case, how would one tackle these kind of issues? Because the country was sure that it needed to develop. The Prime Minister had announced that by 2022 everybody would be housed, and the affordable housing schemes also were in vogue. So taking a clue from that, the Finance Minister introduced a novel provision, section 45(5)(a), which has a limited application, which is not widely practiced, but it still is an important player in the taxation, the direct taxation of the structuring of JDA. So we will deal with that also. Now, what are the direct tax consideration? If you look at it, from a landlord's perspective, one has to first decide whether he is an investor or a businessman. If he is an investor, we will be talking about sections 45 to 55. If he's a businessman, we will talking about section 28 to 43. So therefore, they are two widely different chapters and implications also are different. One is concerned about transfer, the other one is concerned about accrual, right? So therefore, as far as capital gains are concerned, your method of accounting is irrelevant. As far as business income is concerned, your method of accounting is very relevant. So therefore, the organizers have chosen that we need to discuss this. As far as developer's perspective is concerned, not much may turn around for the reason for him everything is an expenditure. The only concern for a developer is that in which year he has to pay the taxes in respect of the business income which he would regularly receive. So we'll address that because it's primarily an accounting issue, and accounting would lead to tax issue. What are, as far as the landlord is concerned, what are the things important is the date of transfer in respect of that part which he has transferred, assuming that he has fully transferred, date of transfer becomes very relevant. And 50% of the tax issues or even GST issues are surrounding this date of transfer. Then what is the full value of consideration? Out of the remaining 50, 25% are relating to what exactly is full value of consideration. For the purpose of section 48, I need to define what is my receipt, and that is what is full value of consideration. And in the context of immovable properties, we have fantastic things. There are innovative provisions like 50C, there are provisions like 56 to 10, and all of them will come together in the circus. So therefore, one will have to look into full value of consideration. The date of transfer of that part which I have retained, which would be developed with the help of the contractor or the constructor, and eventually I would transfer those premises which comes to my share. What should be the date of transfer? For that also is a challenge. What is the cost of acquisition of that part? That is also an important thing. Period of holding of that part. Will I be able to take my period of holding by moving backward from to the date on which I acquired the land, or only to the date when I have been placed in possession of the developed premises is also an issue. The character of income, that is whether it would be business income in my hands or it would be capital gains also, will decide what is the rate of taxation at which I would be paying my taxes. Then lastly but not of least importance is that when I get these flats, premises, which if they happen to be residential premises, will I be able to reinvest by saying that yes, that I have reinvested my gains into these premises and therefore I should be eligible for the benefit of reinvestment oriented provisions. So that is also one needs to see this. Now when I talk of a landlord who is holding the assets as capital assets, the leisure with which I am right now moving ahead, is because I wanted that yes, certain fundamentals are placed clearly before you. And trust me that I will not be able to move at the same leisurely pace because we will have to advance the pace at a little later point of time. So and you will have to be ready for that. The transfer as far as landlord who is holding an asset as a capital asset, what is most important is the term transfer, section 2 into bracket 47. And this is where everything would be decided whether your liability to tax is attracted or not attracted. So in the context of JDA, which are the provisions which could be applicable? One is it could be construed as an exchange of asset. Then in that case, see, clause 1 itself would apply. All of you are conscious that there are about 6 sub-clauses under which the entire game of transfer is played. So therefore, some level of understanding is assumed. There could be an extinguishment of asset. There are cases which say that, okay, this has resulted in an extinguishment of asset as far as the landlord is concerned. So clause 2 can apply. Then there could be relinquishment of asset. You go back to clause 1. The largest number of cases is around clause 5. that when you allow the possession, as a landlord you allow the possession to the developer contractor, at that point of a time whether direct tax is attracted or not. And this is what is all about clause 5. And as I said, 90% of the cases revolve around clause 5. But I am singularly bringing this to your attention that 1 or 2 also can apply. So don't be enamored that if you can exit from clause 5, you could still be hit by 1 and 2. So always keep that in mind. And that in clause 2 there is a diversion. One is that, okay, if I am allowing the possession, whether clause 5 is attracted, or clause 5 is extended also to a possession of that kind which is considered as section 53A of TOPA possession. So is it that, then there are 10 conditions, there are 10 commandments. So is it that if I satisfy all, then only clause 5 applies? There's a serious debate over that. So we will try to talk about it. And as if this is not sufficient, even an arrangement where under the other person enjoys the ownership, enjoys the benefit of the ownership, then in such case also there could be a transfer. So these are different flavors of transfer, and each of it will have to be carefully looked into by you when you advise your client. So what is this doctrine of part performance that we are talking? Because again, see, present day, for almost 15 years, the Bombay High Court decision ruled the roost, telling you that yes, that if you transfer the control and management in respect of a land to another party, then in that case you need to pay taxes on the date of signing of agreement itself. But presently the trend is little changing. After 15 years, there have been people who have been questioning this. And the Supreme Court recently, in not a very clear decision, said that it is important that all 10 commandments of section 53A are satisfied. And that's why I am placing before you that what are these, because as a chartered accountant, we may not otherwise be required to peep into TOPA. But for the practice of income tax, we have to necessarily understand it very well. So what are those commands? They say that when you part with a performance, when you part with possession, in part performance of a contract, so there has to be a contract. And that contract is for what? It should be for transfer. The transfer should be that of an immovable property. The transfer should be for a consideration. The contract must be in writing. It should be signed by transferor. May not be signed by transferee, but it should be signed by transferor. The agreement should be such that it should smell that there is a transfer flowing out of the agreement. It should not be singing a different song. There must be a transfer song, and if that is so, then this is it. Then the possession should be parted under that agreement, or it should provide at least for possession. Then the transferee must have some action. He should have prepared the plans, he should have placed it for approval of the authorities, he should have obtained the approvals, or he must have begun the construction, or he might have made some payment. These are all different actions, and any one of it could trigger 53A of TOPA. So we need to keep that in mind. Both the parties should be willing to perform. Many a times what happens, an agreement is executed, and this is not uncommon. I will talk to you only of such instances and such cases which are relevant and which are practiced. And I will not take your time because of the time which is available to us about theorizing anything. So please try to, respect what we are discussing. So there are agreements. Hundreds of agreements are executed, but no performance has happened thereafter. The agreements are lying in the safe deposit vault. A right is created, but for attracting 247, something more should happen if 53A has to be applied. And for 53A, in order to apply, there must be a willingness. It should not be a document which is just put in a cold storage. So this also please keep in mind. And the last is, and the recent one, is from 2001, 24th of September 2001, this Transfer of Property Act of 1882 is amended, which now makes it compulsory that any 53A document has to be registered. And the Supreme Court famously stated, this is a matter which travelled up to Supreme Court, and wherein the developer was required to pay taxes in crores. And when the matter went to Supreme Court agreeing with the Punjab and Haryana High Court, but in absolutely different context stated that no tax is payable. And the sole reason which the Supreme Court gave was that the underlying document on the basis of which the tax was being levied was not registered. And the document was required to be registered post or from 24th September 2001. So this is the savior for the landlord, that tax was not payable. So therefore, so what we are now talking, I am not advising you to not to register a document. Please do not misunderstand. I am just sharing with you what the law, how the law has developed. Because not registering a document which is otherwise required to be registered could be precarious, and is avoidable. As a lawyer, I would never be able to advise you that. But the point here is that please keep that in mind, that if it is an unregistered document which is attracting tax, then in that case, this could be one of the wonderful contention before the authorities, that yes, that this is an unregistered document which cannot command the taxation. Now, in this background, let's understand that what could be the trigger point. And anything and everything could be trigger point, which you might have right now understood. That primarily the courts are undecided. That yes, that at what point of a time the taxation is attracted. It's not, in a very clear letter. So therefore what happens is many a times, the court's decisions are decided on the basis of the toss of a coin. A person representing you could in your favor, or it would go thank you. As an advisor, you should keep it in mind. And this is kind of a checklist. I thought that, maybe it would be helpful. If you execute an agreement, the golden rule is that that is the date on which perhaps the taxation is invited. So if you wish to postpone your client's taxation, if you wish to defer your client's taxation, then let us see that whether we satisfy all of them or at least some of them. Now, if the agreement is limited for authorizing the developer to prepare plans and obtain approvals, I'll give you my answers also, and most of the answers would be supported by some good decisions. So don't you worry about it. Only that, it would be highly cumbersome to flood you with hundreds of decisions. So I have selected few decisions which would be helpful to you. So first is that if the agreement is limited for approvals and permissions, it would not attract the taxation. It would not attract. If it is for construction, again I talk to myself that if it is not creating rights in land in my favor, then my position that otherwise is that of a contractor. And therefore that in such case also it should not attract the taxation immediately at the first point of time. If it is for marketing, selling, receiving money without the right to sell, then in such case also it would not be considered as an agreement which will invite taxation. Then if it is selling and appropriation, now the danger zone starts. Not only that, the person is authorized to sell, market and sell, decide about the selling price, and whatever he receives, he takes it home. Then in that case, see, even if you have in your agreement provided that this is not a transfer, that 53A does not apply, my caution would be to you that yes, then this is the time wherein it will be deemed that there is a part performance, because I cannot take away the money which is not due to me. The moment you authorize me to take money, that means you have put me into the ownership rights of the premises, and if that is not sufficient, what else would be sufficient? So this you need to keep in mind, that if you are allowing the other person to appropriate sale proceeds, appropriation is a legal term, whereunder the person is not only allowed to keep the money, he is allowed to take it and he is allowed to use it for himself. That's appropriation. When these troika of conditions are satisfied, there is a transfer. Then the next is also an important thing, control and management. This is what the Bombay High Court said all about, and perhaps even it continues to be valid today also, is that if you permit a person to be in charge of the entire development activity and to do everything about development and construction, and the landlord's role is limited to just receiving the money or the area, then in that case there is a possibility that the time has arisen to trigger the taxable event. So please keep that in mind. When the person receives consideration and the landlord is receiving consideration from the other person, isn't it the best time that, the whole game is all about receiving consideration? And if I am receiving consideration which is not refundable, then in that case there could be a taxable event. Permitting sale of units without appropriation, I said it would not attract, but with appropriation it will surely attract. Many a times a case is made out that, look, how is he acting? The developer is my agent. And we ask that, how is he your agent? No, I have given him a power of attorney, and therefore everything which he does, that's the law of agency. There is no doubt about it. But importantly, when a power of attorney is given for a consideration, that power of attorney otherwise would become irrevocable. And most of these power of attorneys which are registered, believe me, that they are irrevocable power of attorney. The lawyer advising the developer will make sure that the power is an irrevocable power. After putting in 50 crores, if his client has to hunt or beg for the money which he has put, he would never put his client into this situation. So therefore, please keep this in mind, power of attorney which becomes irrevocable, and if it is for consideration, there could be a transfer. Yes. Then, if you give a permission, like in redevelopment, you have to give the developer a permission to deal with the members of the society and negotiate and also pay them and agree with parting of the premises. There is a problem. So please look into that. If you permit a developer to demolish the structure, the Indian Easements Act say that, that the license which you had given him to enter the premises on demolition becomes irrevocable. So there is a concern over here also, so that also. So many a times, see, the care has been taken that the landlord demolishes the structure and thereafter hands it over to the developer so that, the tax is not attracted immediately. One single wrong step at a right time could create serious taxable events in your favor. And of course, if you get into a deed of conveyance, sale deed, then there is a transfer under subclause 1 itself. You cannot escape the taxation. Then subclause 6 is an interesting thing that Supreme Court was asked to consider that ठीक है ना, ये सारा नहीं है. All these 15 things which I told you, वो सारा नहीं है. But the point is that the developer is enjoying the property. So why should there not be any taxation? And apparently the argument was very attractive because these provisions have come in 1987. And for last 36 years, the courts have not been able to find a very clear answer on this. The experts also have not been able to find a very clear answer. The law continues to be vague and haunting therefore. So Supreme Court fortunately stated that yes, that enjoyment is essential, but that enjoyment should be that of a de facto ownership. If there is no de facto ownership moving to the enjoyer, the person who is enjoying it, clause 6 should not apply. And this is something is, to my mind, if this is taken care of, you would have done something very good for your client, at least for the time being, and would at least seek some time for him to defer the taxation. So this is all about possession. Why it is all about possession is that I said that what is paramount is clause 5, and clause 5 talks about parting with the possession. The words which are used is allowing the possession in part performance or otherwise. So what is this possession? See, possession is a fountain which has variety of colors. Each flow is differently colored. So what could be? As I have understood is that could be variety of possessions, endless. Anything and everything could be possession, but actual possession is surely a possession. When you part actually with the possession, this is the best proof of possession. As it is said, that a proof of a pudding is in eating it. So when you are enjoying the possession, why would you call that it is not a possession? The doctrine of 53A may not be very helpful. So this is one thing. But when I say the possession is not complete, it's concurrent, it's inclusive and many other things, then in that case, there is a possibility. So legally, there are about 17 types of possession. I have listed some of them. One is that there is actual possession, the physical possession which could be different than the legal possession. There is a constructive possession. You are already sitting into the possession, but your rights of possessions are required today. Like a person in possession of a property under an adverse possession or any such other thing. Or as a tenant also, or a lessee, he is in possession. That could be a constructive possession. Then there is legal possession, adverse possession, there is inclusive possession. I am enjoying it with other. That is a concurrent possession. There is a joint possession and many other possessions. You need to apply your mind to this. But this possession is not restricted to possession itself. Even courts are saying even when possessory rights are parted with, when the possessory rights are parted with, that could be attracting taxes under clause 5, read with 6 or otherwise. So, and what are those incidences of possession? Which is again a separate school of, this is list of the things. And what are they? When you part with an irrevocable power, that could be a possessory right transferred. Power to sell units, which I told you that, but which again falls under possessory rights. Then management and control and supervisory rights, entry into a plot of land, for what purpose is to be seen. Demolition of structure, I talked with you. Even when you permit a person to construct a new structure on your land, his possession becomes complete. In such cases also, there would be a possibility of activating taxation and a taxable event. When you permit a person to mortgage your property, receive a loan for himself and use it for himself, or in some cases he may make you responsible for such a loan, then in such case also there could be a part possession. Please keep that in mind. And when you authorize a person to receive consideration and issue receipt, these are all legal terms. These are not tax terms. Issue a receipt is a document. And therefore, in such case also there could be a concern which one has to think of. Taking it further, to receive an appropriate consideration, we talked about it. When you part with inclusive possession, ठीक है, मैं यहाँ बैठा हूँ, आप भी आ जाइए, that is an inclusive possession. Both of us would enjoy it together. Concurrent possession is another class of it. Receipt of consideration we have discussed. On receipt of constructed area, this is the best proof. I have authorized him to construct 50 premises for me, and he is parting with possession in my favor. Now, if I am not paying taxes just now also, when would I pay taxes? There have been cases, hundreds of cases wherein the people are inclined not to pay tax even at this point of time. And there are court decisions which support this also. Then, handing over of title deeds. Now, this is a legal event. It's not just parting with the documents. When you hand over the title deeds under an agreement, a legal transaction has happened, a legal event has happened. And in this country and in many other countries, anyone who is in possession of the title deeds has a right which is vested in it, especially when some consideration is moving in his favor. On registration, there could be a transfer, which is otherwise not questionable. And on obtaining approvals by authorities, under your permission, without doing anything further, could also be considered as the incidence of possession. So we have understood three different things. Possession, the possessory rights, and the incidence of possession. They are three different things, mind you, ladies and gentlemen. But important is that for the purposes of 247, any one of it could be sufficient. So therefore, it simply is not that, okay, that I have parted with possession, this is something which is still in my pocket, that's not. If I have maybe Sunil, this is your way of telling me to shut down. Yeah, right? No. But sometime I'll have to take a hint. So you only will tell. I don't wear watches. I have no sense of time. Okay. So just please let me know whenever you feel that we all are hungry, because I would also be hungry. So we'll go and do it. Yes, right. Most of the agreements provide very famously that I am not parting with possession. I am giving a license to the developer to enter into the plot of land and carry out his activities. Now, license is not a product of Transfer of Property Act, it is a product of Indian Easement Act. A license is different than a lease, it's different than a tenancy, and it is different than the transfer also. So a limited license is given to a person to enter into, and this is what was the issue before the Supreme Court in the famous case, which is a recent origin case, Seshashahi Industries. I'll share with you the citation. And this decision is followed recently by the Bombay High Court, distinguishing its earlier decision, which was ruling the roost, for last 14 years, 15 years. So in this background, the Supreme Court stated that here is a case wherein, the possession is not parted with at all. Then the court was asked that what is parted with? The man has constructed a multi-storied building on it. And it was the man who constructed the building and the one who had parted with the land. He was saying that, that this should not be taxed in this year. It should have been taxed in an earlier year, which was beyond the point of reopening. And the gentleman who is landlord was saying, now you cannot tax me. The Supreme Court said that no, we will not agree with you. On the date of agreement, you had given only a license to the developer. You had given a license to the developer, and therefore the transfer was incomplete and the tax liability was not activated. It was not invoked. So this is in this background, the Supreme Court therefore said that, that the AO was right in taxing you in a later year, which was after 8 years. AO was right in taxing you in a later year, and what was the reason for the Supreme Court to say? That Supreme Court talked about this incidence of possession. It said that what was earlier given was a license, and therefore we will not attract taxes, we will not support taxation in the year of giving license. So now this has reopened the Pandora's box once again. All these 30 years, see, everybody was struggling with a difference between possession and license, because any agreement worth its salt would have provided that right now I am giving you a license, unless the lawyers or the solicitors of the developer are strong. They would not be happy with the license, because license is an inferior right. It could be vacated any time. So therefore, in such circumstances, what would happen is now a new challenge. But it has also opened an opportunity for us as practitioners to also see that if the parties are comfortable, to inbuilt a clause for providing a license instead of possession. Should you do that or not is absolutely up to you. It's not my advice also. Because I personally am of a view that from a developer's point of view, this is terrible. I'll never ask my client, and most of the time we represent the developers. So I'll never ask my client to settle with an inferior title. But be that it may be so, if the developer is generous and would want that, the landlord's taxation are deferred, this might help. Whether it would help really or not, because in a very peculiar circumstances, Supreme Court in deciding the case against the assessee and in favor of revenue has said something, and we should not be so read that it might help all cases. And my personal view, just in order to conclude this part, is that my personal view is that even when I have recorded in the document that is a license being given, if the license is followed by possession, then it would just be a paper decree. I may be writing that, I may be calling you by one name, but in effect your name is very different. So you may call this as a license, but everything what I have done is indicating that it is nothing but possession. So please keep in mind, because sometimes, see, the wisdom demands that we are controlled. If we go haywire in planning affairs, the clients could be visited with, something which may be then later on, and after 270 capital A penalties and all, it could face you with a horrible situation. And if you are an advisor and which is recorded that under your advice, then you could also be prosecuted. So these new provisions are very, very different. Please read these. All those golden days are over, wherein we could have advised anybody anything, and without taking up the responsibilities. Now department is advised to always look for an opportunity to see that the advisor is also pinned down. In the case of the lawyers as compared to the chartered accountants, the lawyers are saved in as much as, see, they have a confidentiality protection, which as chartered accountants we do not have. And many a time the reason is that those persons who are lawyers and chartered accountants both, they have chosen to practice as lawyers. The sole reason being is there is a confidentiality protection, which is not presently available to the chartered accountants. Even one of the big fours had to carry their matter right up to Supreme Court, stating that, that his premises cannot be surveyed, and, the disk and other documents cannot be taken away. And he is under an oath of secrecy. The Supreme Court said that that oath of secrecy is available only to advocates and not to chartered accountants. So please keep in mind, coming back to license is that under the Easement Act, when a structure which is presently in place, if it is demolished, the license becomes possession under section 60 of the Act. This is something, if this was told to the Supreme Court, maybe the view could have been different. When a person is allowed to construct of a permanent nature, a structure or a building, which once again the license becomes irrevocable. And once it is an irrevocable license, it could be construed to be a possession for the purposes of section 247. Which are the few landmark decisions? I have chosen just 4 or 5. The first one is a decision which was delivered in the context of the rights of the developer. was delivered in the context of rights of developer and the liability to stamp duty. And the Bombay High Court famously stated that a development agreement was nothing but a contract. The developer was nothing but a contractor or a constructor, and therefore the liability to taxation or stamp duty is not attracted. It is this decision which at times argue for the purpose of claiming that tax should not be right now attracted. So those of you who would like to look into this may kindly look into this decision. If you do not have a copy, because this is reported in Maharashtra Law Journal, please write to me and I'll supply the copy. The landmark decision is that of a Bombay High Court in the case of Chaturbhuj Dwarkadas Kapadia. Mr. Dastur, who is the senior most advocate and who is top ranking advocate in the matters of taxation, had argued this case. And he had placed before the platter of the court all possible arguments, and the court finally, the court which was headed by Justice Kapadia, who later on became the Chief Justice of India, the justice held finally that the date of agreement is the relevant part, relevant taxable event on which the tax is attracted. The assessee in this case had already paid tax in the later year. There were various events. Power also was given in a later year. Tenants were vacated in the later years. In spite of that, the court said that what is important is two things. Did you give the control and management to the developer to do everything relating to that, to negotiate with tenants, to settle the tenants, to prepare plans, to approach the authorities, to get the plans approved, even though you did not demolish the buildings, even though you did not start the construction, commence the construction? That was the period when the liability to tax was attracted. And following this decision, various high courts in this country have decided that the date of agreement is the date of this. Though you have tribunal decisions, which have later on tried to distinguish a high court decision. We are in a country wherein each of us believe that we have so much of wisdom that even a Chief Justice of India, if he has said something, will say something, and we will also give you a ruling in favor of that. So, but I am never, encouraged by such decisions. When you are at a planning stage, yes, if the damage is done and if you are representing somebody in the courts, you will surely rely on all these decisions and win the case also perhaps, but not at the planning stage. You would advise somebody relying on such loose decisions. So be careful about it. The next decision is a decision which is just listed for you to understand that here is a case wherein the assessee's landlord said that mera taxation jab main deed of conveyance karunga tabhi lagega. That is when I transfer it to the society, a deed of conveyance. The court said that nothing doing, the taxable event could be much earlier and cannot be postponed to the date of conveyance. Then this is a landmark decision. Normally we are an authority for advance rulings. Decision is applicable and binding only to the person who has sought the advance ruling. But this is one decision which has thrown lot of wisdom. And therefore I am putting it before you. This was a case wherein an irrevocable power of attorney was given to the developer by the landlord. And it authorized inter alia the developer to do all these things which are placed before you, and therefore the authority stated that there was a transfer which would be made liable to tax. The Supreme Court decision, which is of a recent origin, which I talked with you, is Seshasai Steels Private Limited. Supreme Court stated that the case before them was a case of license, और लाइसेंस के टाइम पे टैक्स नहीं लगेगा, सो और बाद में टैक्स लगेगा when the buildings were constructed or sold. So this decision is a very important decision for the players of this. Following this decision, recently the Bombay High Court distinguished its earlier decision, which was 15 years old, and that which wherein the court said that when a license is given, a pure license, a vanilla license, then in that case it is not triggering a taxable event. It was, court said that only when possession is parted with on following 10 commandments of TOPA, at that time there would be a liability to tax. Further to that, it followed the Supreme Court decision. Further to that, it distinguished its own ruling. So these are the four important legs which you need to apply your mind. Then there is another interesting decision, that is Balbir Singh's decision. We made a reference saying that an unregistered document cannot invite taxation. This Balbir Singh's decision also stated inter alia that the clause 5, when it refers to 53A, it refers to all the conditions of 53A, and therefore you cannot, simply because a possession is parted with, you cannot assume that TOPA is not applicable. So this is a doctrine of incorporation which is sought to be applied by the Supreme Court. There is another view possible here, that when a reference is made to allowing possession in part performance of 53A agreement, what is desired by the legislature in the context of Income Tax Act is simply parting with possession and the presence of an agreement. Mind you, why this is relevant is, and why this could still be reviewed, is that the objective behind, in 1987 these clauses were introduced, clause 5 and clause 6. At that time the objective was made very clear, that landlords were not paying taxes for years simply on the pretext that the deed of conveyance was not executed. And deferment of tax for 20 years or 40 years is not permissible. And it is with this objective, the then finance minister, who later on became a prime minister, VP Singh, introduced these provisions. Those of you who are interested, please read into the notes on clauses and also the explanatory memorandum. Justice Kapadia in this landmark decision stated that what is important for me is the memorandum explaining the provisions. And therefore I will not get into anything else, and I will not be swayed by any other argument. So this is what is something which is still a matter of consideration. Now we will speed up the things. Sunil, you will tell me at least 30 minutes in advance. Huh? Okay, very well. 15 minutes frankly is too short a time. That would mean that, today you have invited on the third occasion to talk on the same subject. Now you will have to invite me fourth time. I would not wish to do so, but I am just telling you. It's very difficult now, for me to travel around. So, but yes, we'll try to do so. Now, this is when an agreement, a development agreement is executed for a measurable consideration. Meaning thereby, it is possible to say that the consideration which will be flowing from developer to the landlord would be 50 crores, 20 crores, something, which is measurable at the time of execution of agreement itself. Then in such case, the case for taxation for the department would be stronger because A, the agreement is executed. On execution of agreement, activities are being carried out by the developer, and what is due to you is also ascertained. There is no uncertainty about the consideration which will eventually come to you. We have always been taught that under the practice of Income Tax Act, for the purposes of levy of capital gains tax, the receipt of actual receipt of consideration is not relevant. Yes, what is important is it should be quantified, and if that is so, subject to all that what we have discussed, mind you, now whatever we would discuss will also have to be read and concluded in consultation with what we have so far discussed. whether there is a possession, whether there was a possessory right, whether there was an incidence of taxation, whether any of the clauses are applicable, whether there is enjoyment, and if any one of it is there, and if agreement is also executed and the consideration is defined, ladies and gentlemen, that is the time for you to advise your client to pay tax. In all these cases which I have individually taken up, the previous one and now what I have also tried to address what would be the consequence in the hands of the developer. Now I will avoid telling you about, because it's not of a great consequence, and you all senior people would surely know that what will be the consequence, because for a developer it is a cost. If we keep that an underlying presumption before us, then the only thing which we need to explain to the authorities is whether it was the year in which the cost was incurred, because the deduction is granted in the year in which the expenditure is wholly and exclusively incurred. If a liability is attracted, that is the time for claiming deduction. And for a developer, anything which is required to be done normally would be eligible as a deduction, whether it is land cost, construction cost, anything. Whatever is paid to the landlord is deductible, with a caveat that yes, if anything is bordering on illegality, then that amount would not be allowed as a deduction. That one needs to keep it in mind. Now, measurable consideration, and which are the decisions? These are the decisions, see, which is very clearly telling us that there is a liability to tax. As against you that, this is something I would like to spend 2 minutes on it is, and it's interesting is, and it's little different. So far we have been talking about the taxation of the landlord. Now when we talk about the taxation of a businessman, and we have taken just peculiar situation, not that of a businessman who doesn't want to act as a businessman, not to act as a developer, but he is still in business. He has a land back, he is a dealer in land, he is also a developer, but there is a project on which he is stuck, and he therefore wants to give away the development rights in respect of that land to yet another developer. Now in such case, shortly telling you is that provisions of section 2 subsection 47 would not apply, because for a developer who is holding an asset as a stock in trade, he is not holding it as a capital asset, and therefore 2 subsection 47 will not apply. All that we talked about in the earlier table. Is this clear to you? Right? You'll have to do something about it. Yes. Yes, the parameters for inviting a taxable event are totally different. And which are they? Which are they? Can any one of you share with me? Because all of us are in practice for donkey's years. The important consideration for a businessman is that income should have accrued, or it should have been then in that case, on receipt it would be activated. But in most of the cases for a businessman following a mercantile system of accounting, what is of importance is accrual of income. And where do you get this accrual concept? You get it from section 28. 28 seeks to tax a business income on accrual, read with section 4 and 5 of the Act. And then the million-dollar question is, when does an accrual happen? The accrual ordinarily would happen as per your method of accounting. And your method of accounting is prescribed by section 145, read with 145(2)(a), which talks of ICDS. Now in this background, what is very important therefore is that that whether accrual has happened. When a developer enters into a development agreement for facilitating its business, an accrual, in my limited opinion, would not happen on execution of agreement. It would happen only on realization of profit out of that business. It's a business venture for himself, a separate business venture. And in that view of the matter, it is possible for him to say that as and when the premises which are constructed for him under a development agreement by a joint developer are eventually received, that could trigger taxable event, or better is when they are sold and the profits are realized, and that would be the year of taxation. So this is something that this is an area of difference between the taxation of a developer who himself is a businessman, and the taxation of a landlord who is holding it as an investor. Then sharing of revenue. Now instead of defining the consideration, you say that ठीक है, आपको ये जगह दे देता हूँ, whatever money you receive, 50% would come to my platter. Now in this case, the biggest challenge is that what or section
हेलो
ऑन है, ऑन करता है. Yes? Yeah. Am I audible? Sorry for this. Yes. So when you share the revenue, the only challenge is how to determine the top line. That is, for section 48, you have to deduct cost from something. So what is that cost, right? That is the thing. The challenge is met in two different ways by the law. One is 50C. Now 50C provides that irrespective of whatever is your consideration, whatever is the stamp duty value, if it is higher than the agreement value, that value would be adopted. Of course, there is a challenge that there is no agreement value finalized here. That's one. Second is there is also a provision called 50 capital D, which says that when the full value of consideration is indeterminable, then in such case 50D can apply. Now, so these are the two challenges. I am of a personal view that neither 50C nor 50D can apply in such cases. However, as per the science of valuation, if the present day value of the premises which I am likely to receive, if it could be computed, that would become my agreement value. And if I compare that with the stamp duty value, there is a possibility of calculating the capital gains under section 48. But this would happen only if there was a possession, if there was a transfer. If there is no transfer, this what I am talking presently will not be relevant. I hope I am making my things clear. Sharing of revenue can surely attract taxation, but the challenge is that how to compute capital gains. And we have discussed the ways and means of computing the capital gains. I am not saying that sharing of revenue may not attract taxes. So simply because you get into a JDA for sharing of revenue, you are not postponing taxation. You will have to apply all that we have learnt earlier. So please keep that in mind. Then sharing of project profits, this is one of the worst recipe which one has. Now when you share the profits of the business, then in that case what you do is that you are entering into a joint venture which would be labeled either as an association of persons or a body of individuals, right? Or if it is a company or an LLP, then it is SPV. Then in all such cases, there is a transfer. Make no mistake about it. Make no mistake about it. You will be taxed only in respect of the profits of your enterprise. And that profits, depending upon your structure, would be taxed or would be exempt in your hands as a partner. But importantly, when you introduce this capital asset into an organization, into a business enterprise, 45(3) could be triggered. And I have listed the cases, even the famous group in this country that DLF could not get out of this. So therefore, please apply your mind to this, is when you get into sharing of profits, there is a transfer. And then there are all other issues. If you have labeled it as a partnership or an LLP or a company, life is simpler. But if the department treats it as an association of persons, all other challenges of stamp duty could arise, 45(3) could arise, then 67B would arise, 110 also would arise. This is all about AOP taxation, so please keep that in mind. As far as developer is concerned, when it is introduced in his books, and thereafter he treats it as a stock in trade, then 45(2) can be activated. That also. So this is something which is avoidable. Unless you are very clear that you want to pay taxes, do it. Because इसमें stamp duty भी बचेगी नहीं. The stamp laws are very clear that on introduction stamp duty is payable, be that Gujarat or is that Maharashtra. Then area sharing agreement. Here is again a case wherein the consideration is not defined. Subject to all other challenges of that being labeled as a transfer, assuming that it is labeled as a transfer, how to compute capital gains is only a challenge. And again, the challenge could be met out of the finding out the net present value or the ready reckoner value or the circle rate of the premises which you are likely to receive, and based on that, or the circle rate of the land which is sought to be transferred, one of it which is higher, there is a possibility of calculating capital gains tax. Mind you, you will never be able to get out of a tax liability simply on the argument which we have been conversing for last 30-40 years, is that look sir, I am willing to pay tax, but मेरा gain कितना है मुझे पता नहीं है. That is no more permissible. Supreme Court in a landmark case in A.R. Krishnamurthy's case stated that you need to make an attempt to calculate the capital gains. It may not be something which could be a cakewalk and given on a platter to you. You make an attempt, and in some manner with the methods of valuation it is possible to value your consideration. That would be the time when the tax would be payable, unless other conditions are not satisfied. Area sharing I have talked. This is one thing I will spend another 2 minutes. Now Sunil will try to see that your deadline is met, but permit me to move little fast, very fast, okay? Right. So this is development management agreement. This is something which is presently practiced, see, and it's something which is one of my pet things, in the reason that when crores of rupees of taxes are payable, it's impossible for persons to. And in addition, if I tell you that, when you get into a development agreement with a developer and you are the landlord, the GST also is immediately attracted, because it is considered to be a case of a barter. And if it is a commercial development, the GST is not even deferred. So therefore, there is huge liability of taxes. It's another story that developer who might be under a reverse charge mechanism would be required to assume the liability of GST also. But that is not something, there is a leakage of the funds which otherwise would be gainfully employed for construction. So therefore, to do away with that, this development management, which is known as DMA or PCM, are the agreements which are so structured that land is not transferred, the title in land is not transferred, an irrevocable power of attorney is not given, but the developer is engaged with the clear-cut understanding that he will not act only as a contractor, but he will manage and supervise. He will manage and supervise the entire development activity. And in some of the cases, one has also structured that he will be responsible for arranging the funds also. And in that case, the landlord who is now so far holding it, this is the another leg of the understanding which has to move parallelly, is that the landlord, when he appoints a DMA, he should not be under any premonition that there is that now he is not changing his hat. He is changing his hat from that of an investor to that of a businessman. He is appointing a business. So there is a systematic continuous activity carried on for a regular period in a repetitive manner which satisfies the conditions of subsection 13 of section 2. So he has to convert himself, his capital asset into stock in trade, and this gives him wonderful benefits. So 45(2) is attracted, his liability to capital gain is frozen, but he is not invited to pay tax immediately. As and when he would realize the premises or sells the premises, at that time he will have to pay tax. Of course, that tax would have to be as a business income. But the major part of the profits are captured in the form of capital gains. I believe that if you have understood this, please apply your mind. The only concern is, which may come, is from the developer. He would say that, sir, you are not giving me any title, and you asking me to put some money into it, which are huge amounts. So it is here, if you can, in consultation with other agencies, decide that how best you can make the developer a comfortable person. This is a win-win situation for both the parties. Joint venture SPV, I said that this will attract taxation. Then the specified agreement, I'll take few minutes and make you understand. This is a new provision which has been introduced by the then Finance Minister Arun Jaitley to safeguard the interest of the investors by permitting him to defer taxation. But what happens is, it's my understanding, and it's not necessarily with legislature or courts or any other government agencies, that when you try to solve a problem, it brings new problems to you, and those problems are taking longer time to solve. So when 45(5)(a) is introduced, the simple thing is, it says that if you are an individual or an HUF, it applies only to two. If you are owner of the land and building, which is held as a capital asset by you, and you have executed an agreement which is not a JDA kind of, but the nomenclature here is specified agreement, and the agreement is to share the development project. The part of the area would be shared by the owner. Then if all these 5 conditions are satisfied, you are welcome in the fold of 45(5)(a). And what is the benefit is that you would not have to pay tax immediately. This is a wonderful thing. Of course, it's a good license that I don't have to pay tax immediately. So when do I have to pay tax? The tax is to be paid when the project is completed by the developer and a completion certificate is obtained. So this is good. But the catch here is that the tax has to be paid not on the value of the land, but on the value of the area which you would receive. So your tax which you would have paid on 10 crores could become now 30 crores. But it would still be capital gains tax, not a business income. So it is this which has been provided for. And there is another catch which says, in the event if you ever decide to sell a part of the share in project or the full of the share in project, then the shelter of 45(5)(a) will be taken over. And therefore, that it would immediately attract liability to tax. The law is not clear in which year. Do I go back to the year of agreement, or do I go to the year in which I have sold this area which is part of the sharing project? So that is one of the issues. So this is broadly 45(5)(a). a provision which is laudable, which is introduced with the noble intention, but has serious issues, you know. See, some of them are listed here, you know, and there are many of them. Someday we will discuss about that, but they are explanatory by itself. It doesn't require my presence, you know. So I am not the one who holds back anything. So please apply your mind and you will understand that what I mean by, and there are about 20 issues. So therefore, before you venture into 45(5)(a), please apply your mind to this checklist so that you would be clear. This method of accounting is wonderful. Okay, someday, you know, see, because after all, you know, basically we all have begun first as chartered accountants, and therefore accounts is something which come very easily to us. Tax is something which is easier at a later point of time. So what is this method of accounting? आपको 5 मिनट में सबका summarize बता देता हूँ. Ordinarily I would have enjoyed 30 minutes on it. So सुन लीजिए करके. This method of accounting is that there are two methods in accountancy. Completed contract method and the other one is percentage of completion method. POCM or CCM, दो methods है करके. This is. Now these methods traditionally were prescribed by Accounting Standards 7. Accounting standards are introduced in this country in the year 1983 and 7 came in 1985. It was made mandatorily applicable to all those enterprises whose accounts were required to be audited. This is what it is. So accounting standards were required, and where you were company, then under section 209 of the 56 Act, 1956 Act, they were made applicable. So 7 had provided that it will also apply to real estate developers. It will apply to real estate developers, and 7 permitted to choose any one of the method, CCM or PCM, POCM. So we will keep this in mind. And most of the cases were decided around that, wherein the court said, including Supreme Court said, that when the institute is permitting a method of accounting which permits him to recognize revenue on completion of project, who are you as a taxman to stop this? So this is what was the famous understanding. And on this also there is Chief Justice Kapadia's decision in the case of Bilahari chit funds or investments. So that this is what was the understanding. In 2003, Institute came out with another standard, substituted AS7, and stated that the new standard, the revised AS7, will not apply to real estate developers. Will not apply to real estate developers, period. And it said there is no choice of method anymore permissible. The only method is percentage of completion method for construction contract. Fair, right. Then there came, so there was, everybody was in a quandary that kaun sa method apply karna hai. And the businessmen always wanted to follow project completion method. So the matter was put before the institutes. The expert advisory committee came with an opinion somewhere in the year 2005 stating that in such an event accounting standard 9 would apply and you would be permitted to follow CCM, that is आप project completion method follow कर सकते हो. So this was, everybody was happy कि even when AS7 shelter was withdrawn, AS9 permitted me to follow the project completion method. But in 2006, institute under, I am told that under the advice by the CBDT, came out with a guidance note stating that the real estate enterprises should be following only percentage of capital completion method. And for deciding how to follow percentage of completion method, go back to Accounting Standard 7. This is what institute said. So it said first it is not applicable, then it said that आप फिर से उधर जाइए. So this is 2006. So 2006, but did not provide with examples that how to go about this. It simply said AS7 को apply करो, and the AS7 as it then was did not have a detailed mechanism for application of it. So in 2000, So thereafter there was a heartburn that the person could not, in accountancy at least, follow the project completion method. In 2012, a revised guidance note came. In 2012, a revised guidance note came, which now in detail stated that what would be the time when the property in goods is passing, when it would be assumed that risk and rewards of an enterprise are assumed to have been realized, and when it would be said at what point of time the percentage of completion method is to be applied and how it is to be applied. So 4 stages have been clarified in this 2012 note, which is 11 years old and which is live and kicking. And which has stated that 2012 guidance note is not for construction contractors but for the benefit of real estate players, businessmen. So 2012 is applicable. Now we have seen that accounting standard, there is no accounting standard. 7 is not applicable, so guidance note is applicable. And guidance note would apply under the generally accepted accounting standards, principles. That's the way one would go about it. Now, supposing if you do not follow the guidance note, now for the chartered accountants in practice, following guidance note is mandatory. And if you are auditing something and if your client has not followed the guidance note, you will have to disclose that and qualify it also. And you will have to measure the profit factor on the profit which is not shown. So this is guidance note, but it is not compulsory under law, for the non-corporate entities to follow guidance note. So what is required for a chartered accountant is to disclose that guidance note is not followed. And if he has disclosed that, then in that case, can he still follow a percentage completion, the completed contract method, or which is famously known in taxation as project completion method, is $1 million question which will remain open. My personal view is I am not permitted, because the taxation will be determined in the context of section 28 read with 145. 145 is the method of accounting. Institute of Chartered Accountants of India is considered to be the leading and only authority to provide for the accounting principles. And if the institute in its wisdom has required you to follow the percentage of completion method, then in that case that would be the method which is a mercantile method of accounting in terms of section 145, and therefore it would be deciding the time of accrual of income under section 28. But this is other view is possible, and that is where we will take little few more minutes on that is. Now, those who are not required to follow accounting standard but are required to follow Ind accounting standard or IFRS, then in that case there is a window open there. Those companies which or enterprises which are required to follow IFRS or Ind AS 115, Ind AS 115, which provides for recognition of revenue. The relevant paragraphs are 22 to 49, but for which for us is paragraph 34, 35 to 38. These are the paragraphs which provide that in a case where property is said to have passed or the control is said to have been passed, then in that case there are 2 methods in which you can recognize revenue. One is over a period of time. Over a period of time, that is OPOT in short. OPOT is nothing but a percentage of completion method. But Ind AS cautions you that you better not follow OPOT. OPOT can only be followed in cases wherein the property in goods have passed over a period of time. If the property has not passed over a period of time, in case of construction and real estate development, it's very difficult to say that property is passing to the buyer of the flats in stages. So this is there, but there is a window open. Some of the firms have taken a view to apply POCM. How would they finally succeed? I do not know. I'll keep my fingers crossed. But the other method which Ind AS has provided is that you recognize the revenue at a point in time, APIT, at a point in time, and which is nothing but CCM or the project completion method. So Ind AS 115 companies are invited, in fact, they are forced that they should follow only the CCM or the project completion method. So if you are one who is in the business and to whom Ind AS 115 applies, then in such cases you are welcome to do that, and legally and also in terms of accounting. Last thing about this is, if you are still a die-hard champion of the project completion method, then you would be able to succeed, at a later stage before the courts, wherein the courts have stated that under the generally accepted accounting principle, a completed contract method which measures the revenue at the same value by following any other method, then it should be, if it is regularly followed, then it should be done. But those of you, who would like to follow that advice, I would recommend that you please read para 21 of Justice Kapadia's decision in Bilari Investments Company's case. He has devoted a special paragraph allowing the decision in favor of the taxpayer to defer the taxation by stating that post 2003 you are advised to follow accounting standard, which is a kind of a caution that that you cannot be so adventurous to follow that. Now that would leave me with, see, all these I have covered, including the taxation. 43C, 43CA and CB, please look into that. Then ICDS. ICDS 3 and 4 are made mandatory, whether they would apply to you as a real estate player or not. So there was a doubt. To cut the whole issue short is that the Central Board of Direct Taxes has drafted a separate ICDS on real estate, which is yet to be notified. Therefore, in principle, it is accepted that 3 and 4 will not apply. So presently 3 and 4 is not there. There is no ICDS on real estate. Now in the end, Institute in its guidance note has stated that ICDS will not apply to real estate enterprise. So this is, so coming back to this is, you are back to section 4, section 5, section 28 and section, they are different from accounting standard 7 also. But 43CB read with ICDS 3 will decide the taxation part of it. हाँ, inventory में इतना समझ लेते हैं. Ordinarily we have been taught that accounting standard 2 is the one which should apply for valuation of inventories. Fair. Then there is ICDS 2 which also is valuation of inventory. But ये दोनों कह रहे हैं that we will not apply to the immovable properties or inventory of immovable properties. They also say that work in progress would not be measured under the accounting standard 2 or ICDS 2. Then in such case, what would be the standard which would be, or guideline under which I would be required to value my inventories? So as I look at it, I believe that finally accounting standards or Ind AS or any guidance comes, has to be within the ambit of generally accepted accounting principle. So Indian GAAP to lagega isko. So Indian GAAP for valuation of inventory, Institute at some point of time had clarified in an expert advisory committee's opinion that in such cases the inventory would still be valued at the lower of cost or net realizable value. So net realizable value or the cost, these are the guiding factors for work in progress as also for land. Land, I will not believe that it can ever become a part of the work in progress, but it is separately to be valued. So if the land's value is diminished, it will be valued at a lower cost. Similarly, you acquire various rights which are known as FSI rights or TDR rights, which flow out of the development control rules. So when you acquire those rights, they would also become a separate asset and would not become a part of the work in progress. But the underlying formula would be that in respect of all such things and also in respect of finished goods, the cost or net realizable value is the one, the lower of it has to be applied for computing the taxation and for the purposes of accounting also. And there are few Supreme Court decisions which have said that this would be so. Last thing is about redevelopment of society premises. Is that here is a case wherein there is an existing society consisting of say 45 members. It is sought to be redeveloped. The issues that arise are that society is the owner of land and building, but the members have the right of residence in these premises. The developer is appointed by the society and the members collectively, and the developer is promised कि आपका जो 1000 square feet का premises है उसके against में हम आपको 1500 square feet का premises देंगे. The another thing which is promised is that कि आपका area बढ़ जाएगा, आपका taxation भी बढ़ जाएगा, because now you will pay property taxes under the revised scales. So therefore to meet that we will give you something which is loosely called as a corpus payment. Corpus payment एक fund आपका बन जाता है, उसके ब्याज में से you can pay the higher taxes. The third is that you are given a hardship allowance कि ये सारा अभी you have to go away from the place, your children will have to be housed in different schools, your furniture may be repaired, all such things, and you are displaced from an area which you are familiar with, then in such case hardship allowance is given. So एक पहला दिया जाता है, एक बड़ा नया फ्लैट दिया जाता है. Second is that you are given some kind of a corpus. Third is hardship compensation or allowance is given. The fourth is that इतने ये 3 साल लगते हैं, कई प्रोजेक्ट में तो 6 साल भी लग जाते हैं, 5 साल लगते हैं, तो ये सब में ये हम रहेंगे कहाँ? So that the developer agrees to pay you a handsome amount which is known as a temporary alternative accommodation allowance कि आप ये पैसे से कहीं और पे भाड़े पे रह जाइए, होटल में भी आप रह सकते हैं. And if you have your house of your own, you can use this money to buy another flat also. So it's up to you. So this is the fourth allowance which is given. Then all small allowances like shifting allowance is given for shifting from one place to another. Some furniture and fixture allowance is given. All such things. The story is about कि इसका सबका tax में क्या इंतजाम है. What would happen to all the such things? In the first challenge is under 56(2)(10) that whether the owner of the premises instead of 1000 square feet is receiving 1500 square feet, तो ये जो 500 square feet का जो रेडी रैकनर वैल्यू है, सर्कल रेट है, उस पे टैक्स लगना चाहिए कि नहीं. Now if you would carefully look into this, 56(2)(10) can apply to your case provided the consideration is inadequate. When I am giving a permission to construct new premises, without which permission, say, he would never be able to construct the premises. He will never be able to demolish my premises. Then in such case, is that consideration inadequate? The answer is it is not. It's not that developer is charitable and he is my friend and therefore he is giving me 1500, बाकी के सबको 1200 दे रहा है. It's not so. So there is a commercial consideration moving, and in my personal opinion, that of course these are all green shoot issues, so there are no direct decisions, but in my personal opinion 56(2)(10) should not apply. The second is, the first thing which I am getting is the house which I am getting. So then all of you are clear that अगर house transfer किया और दूसरे उसके सामने, if you are getting other house, then I should be getting 54, isn't it, right? No? And 54 I need to comply with other conditions, right? That I should acquire the premises within 2 years, which is not so in most of the cases, or it should be constructed for me within 3 years, it's all right. But if it is not so, you should put in stringent conditions that requires developer to give you within 3 years. And you should tell him that, my kitchen you shifted from one place to another. So it could be considered as you are constructing the premises. And courts are kind to such situations. Then in such case, there is a possibility that you will get 54. But if these conditions are not satisfied, there is a problem. The remaining condition of 54 is, You have to keep these premises for another 3 years. That also please keep it in mind. If you are careless about it, then you can invite taxation of a different kind. Then the next is the corpus which you are receiving. Now this corpus, why are you receiving? You are receiving it only because, there is a serious inconvenience faced by you. And that inconvenience is on finance account and on a physical and a personal account also. So traditionally it was believed that corpus is a part of the full value of consideration and will go into the computation of capital gains. That's all. But nothing beyond that. But then some of the tribunals started taxing it as income from other sources. So this was another extreme. The pendulum was swinging from one to another. Recently, one of the Mumbai tribunal decisions has stated that this also is nothing but hardship. So to cut the issue short, my advice to you would be, please do not take this money as corpus. Instead, say that this is a hardship allowance. And once you say it is hardship allowance, together with another hardship allowance which you are otherwise receiving would not be taxable, and that is a correct view, that anything which is received to bear with the personal inconvenience is a capital receipt not liable to tax. It's not a consideration for transfer of the old premises. If this is acceptable, then the next is a little challenge when you receive, and sometimes people receive crores of rupees being the rent for 3 years. At times, this rent is very expensive to get housed in. Now, what is the taxation of it? There are 3 ways of looking at it. One is that, this is being paid to me to bear with inconvenience, and therefore it should not be taxed at all. There is a good possibility for this. But tribunals are not kind to this. So what tribunal says, that I would say that, sir, then in that case this is nothing but part of capital gains. But tribunals have stated, some of them have stated, that this is income from other sources and it should be taxed on an annualized basis, as and when you receive. I don't agree with this at all. Sometimes, see, all of us, we go haywire, and this is a classic example. But then some later other tribunals stated that, sir, but मैंने इतना खर्चा किया है, उसका क्या? So tribunal said that, अच्छा, I'll allow you the deduction if you have paid actual rent. But when I have not paid, there is a taxation. So therefore the law decided by the tribunal benches is not clear. The best view according to me, either it is not taxable because it is nothing but personal inconvenience receipt, or in the alternative, it flows from one agreement. See, agreement is the fountain from which everything flows. There are different streams of fountain, and therefore everything should go into the computation of capital gains. And if you have utilized this money in furnishing your new flat, then in that case you do not pay any taxation. So therefore this is something which will require a little careful planning. I am sure that that we are not dealing with tenancy or the slum. In any case, I had not scheduled it for that. But by and large, I have tried my best, to see that, that I share some of what I understand. With that, permit me to, share one last thing is, this is not about taxation or accounting. Neither it is for today's seminar also. This was a time wherein there were long queues. There were long queues, which were, formed for the purposes of obtaining the visas of different countries. Obtaining visas of different countries. And the reason was that lot of people from the country were willing to move to other country. Because they felt that, it's good to move to other country. You have famous people, no? They feel that, that they are frightened by staying in this country. So this was some era. It is not necessarily the current era. Then there was a change of the premier. Perhaps we can take it in the context of Pakistan. Everybody wanted to leave that country, but then General Musharraf came. And then he viewed this. He could see, and he was pained that why is it so happening. So he was told that ये सब problems होगा इसके लिए. So general said that I will try to see that, yes, that the queues will be shortened. So when he came in power, there was a fear that, if they leave country, they will be prisoned. So therefore, for some days, the journal was all right. Then one day when he saw that again, there were long queues which were formed, then he told his crony that, why this is happening? That in a short period, when I am ruling, everybody has become so rich that they all want to travel to the foreign countries. So his friend, he told him, sir, that is not the case. As you have come again, all of them have started fleeing. So if I sit down again, all of you should be happy. Thank you so much.
Thank you very much, sir. I request all to give a big round of applause as a gratification to Kapasi sir. Sir, you have taken each and every aspect of real estate, and yes, we are sure that in coming years, you have to come and deliberate and discuss on all aspects. Thank you so much.